Hello everyone, welcome to our Egyptian online seminar group. First, keep your phones off. Then, if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming dear Professor João Granja. João Granja is an associate professor of accounting at the University of Chicago Post School of Business. The primary focus of his research is in investigating the role that disclosures in pre-saving financial stability in the banking industry. His papers has been accepted in top-ranking journals such as the Journal of Accounting Research, Review of Financial Studies, and the Journal of Finance. And his research has been covered in major mainstream newspapers such as the New York Times, Washington Post, Wall Street Journal, and Bloomberg News. He completed his PhD in accounting from the University of Chicago, Post School of Business. Now we will start our seminar with dear Professor João Granja.
Oh, thank you so much for the introductions, Mohammed. I'm, very happy to be here talking to this community. So I'm presenting today current expected credit losses and consumer loans. This is actually a substantially revised. It's the first time I'm presenting this substantially revised version of this paper that I have with Fabian Nagel, who is a PhD student from Chicago Booth, who is currently on the market. And we're very much looking forward for any comments that you may have and how we might improve our paper even further. Okay, so very much looking forward to hear from you. So the paper, basically, this paper starts about 15 years ago, okay? So right around this time, 15 years ago, policymakers, politicians were trying to figure out what went wrong in the previous fall. What were the factors that led to the demise of Lehman Brothers, Washington Mutual, and that basically precipitated the economy in made it be in a depression. Okay, so there was a lot of pointing fingers around. People blamed the regulators for not supervising properly. People blamed the credit rating agencies for basically assigning ratings that were too favorable for these financial instruments that then basically failed. People pointed fingers at the greedy executives. And there was even some blame to go around to the accounting standards and for the accounting standard setters. Okay, so basically, in that regard, people complain that the current standards governing the valuation and the creation of loan loss reserves basically allowed banks to record loss reserves that were too little, too late. Okay, so they basically didn't create a large enough buffer to withstand the large losses they basically came to have in 2008 and 2009. And partly the reason is that people complained that the standards actually didn't allow companies to basically look forward and create buffers that were large enough to basically create this buffer. Okay, so standard setters around the world actually embarked on a long journey toward changing the standards from one that is basically on an incur loss model to standards that are based on an expected loss model. Okay, and in the United States, basically the process culminated with the adoption of ASU 2016, which became effective for large institutions beginning in January 1st, 2020. So almost 12 years after the financial crisis had happened, but it didn't happen. So this paper is going to be talking about these things. Okay, so the adoption, even though there was sort of a lot of blame going around to the standard setters into the accounting rules for basically partly allowing these things to happen, the adoption of this new standard was actually highly controversial. Okay, on one side, you basically have FASB and the standard setters in the United States saying that the adoption of CECL was going to be a wonderful thing, okay? The adoption of CECL will allow banks to create buffers against loan losses in good times that will then protect the balance sheets against really large asset value shocks in bad times, okay? And basically, if you hear sort of someone like Hal Schroeder, who was a former FASB member, talking in testimonies and basically in some of these speeches, he's of the view that the adoption of CECL will have very little implications for the access to credit and the price of credit in credit markets. The banking industry, on the other way, basically was going up and down and jumping around, basically saying, well, that's completely not true, okay? This standard will be the worst thing that happened to banking in the last 20 years. It will actually make the lending more pro-cyclical rather than less cyclical. And because it will force us to raise capital requirement, it will force us to basically keep higher capital buffers, it will in turn force us to basically increase the price of credit and constrain access to credit to populations, especially disadvantaged ones, okay? So there's a lot of debate about these congressional testimonies where members of the banking industry, then the American Bankers Association were complaining about this. FASB thinks they should go ahead. They did go ahead. But these opposing priors and the importance of the standard for bank accounting in this industry basically tell us that we are in need of more rigorous research that informs this debate and allows actually policymakers to make potential adjustments going forward, to basically think about what are the implications of this policy, such that they basically can make sort of some evidence-based important policy decisions, okay? And so basically, FASB member Schroeder, Treasury Department, and even very important academics such as Ann Beattie have basically put out sort of research pieces and statements saying that we need more research on this. So that's where basically we're trying to come in. And so basically we're trying to study CECL. So before going there, let me just tell you what CECL did in practice, okay? So basically, there's two sorts of loans, okay? There are heterogeneous loans, and these are loans that are so customized that must be evaluated on a loan-by-loan basis, okay? Think of this as sort of as a loan to a small business, a syndicated loan with a substantial loan size, okay? These are loans that are tailored to the customer and that must be evaluated one by one, okay? Under the incurred loss model, basically banks were supposed to create provisions for this type of loans when the borrower's quality unexpectedly deteriorated, okay? So that's the sense in which it's an incurred loss model. Only once the loss basically was incurred, only once it became very reasonable and predictable, were the banks supposed to actually set aside the provision, okay? Under the CECL model, now banks are actually supposed to create provisions for expected lifetime losses at the inception of the loan, okay? Then we have homogeneous loans, okay? Homogeneous loans are loans which sort of work a little bit like commodities. They are very standard, okay? And this standardization, think about, for instance, mortgage loans, they're pretty the same. They are defined by some important parameters, like a loan to value, like a principal amount, but by the credit score of the client, but they are very much the same. They can be defined by a constrained number of characteristics or parameters, right? And so those loans are evaluated on a portfolio basis, okay? So think mortgages, consumer loans, etc. Okay, so under the incurred loss model, these loans were supposed to banks were supposed to create a provision for these loans when they were originated. But here's the catch. The provision was only supposed to cover for expected losses in the next 12 months, okay? When we moved to a CECL approach, we're also going to be doing provisions on these loans when in the moment they are originated, but now there's a lifetime approach to this provision, okay? So there's the provision that we make under the CECL model. It's supposed to cover for the entire expected losses over the lifetime of the loan, okay? So this lifetime approach and angle is going to be very important to everything we do in this paper. So I want you to keep this in mind for now, okay? So what we do is the following. So we have 3 research questions. So the overarching thing that we're going to be going after is what was the impact of CECL on consumer lending, okay? We want to basically inform the previous debate that I was telling you about, standard setters versus banks, okay? And so we want to basically learn about these things, okay? So then there's sort of 3 sub-questions, right? First of all, we want to understand how CECL affected the pricing and availability of consumer loans, okay? Second, we want to understand the mechanisms through which CECL operated. So we're going to try to understand the role that capital requirement, those capital requirements that banks were talking about, the role that the capital requirements played in driving changes in the pricing after the adoption of CECL. Finally, we're going to have a third angle, a third question to this paper, which is, did it have incremental impacts on individuals with low credit scores? Meaning, could CECL have had a redistributional impact, an inequality impact in that actually the low credit score of individuals seem to have been more affected by rising rates after the adoption of CECL? So these are going to be sort of the 3 questions that we're going after in this paper. The implementation is going to be the following. First of all, we're going to have a very simple model, really, really parsimonious. If there's any serious in the crowd, please forgive us. The model is going to be really simple. But at least to me, it's actually, we think it's a useful model, okay? The model basically is going to first lay out the market conditions under which we might expect the adoption of CECL to have an impact on credit access and rates, okay? Then it's also going to lay out really clearly the mechanisms through which these impact operate, okay? And then the part that I actually like the most is that even though it's a very parsimonious model, it's actually going to help us a lot discipline our thinking in allowing us to transparently lay out our empirical specification and also really sort of understand what are the main assumptions that we're making when we lay out an empirical specification like that. I'm going to try to guide you through all of these points later on, okay? The second step of the paper, and to be honest, sort of the meat of the paper, is sort of we're going to estimate these price and quantity effects of CECL. And so to do that, we're going to use novel data sets, completely novel data set from TransUnion, with a large US credit bureau that collects information on individual loans for millions of individuals, okay? And so we're going to sort of draw information on the characteristics of individual auto and unsecured personal loans that are recorded in this data set. And we're going to use this data set to really try to understand sort of what's the impact of CECL on these lending markets, okay? We're going to have to be really careful. Unfortunately, the adoption of CECL for large banks on January 1st, 2020, really coincides with the advent of the COVID-19 pandemic, right? So we're going to need to be really shrewd about laying out an empirical specification that allows us to tease out the effect of the CECL adoption with the effect of COVID-19 pandemic. So we're going to try to basically do that. Again, I'm going to tell you how I feel our empirical specification really goes a long way towards doing that. Obviously, it's never going to be perfect, but at least we're trying our best here, okay? And so we're going to use these insights from the conceptual framework that we lay out in step 1 to actually estimate and set up and estimate this triple difference specification that allows us to be more confident in our ability to estimate the effects of this new standard, okay? So what are the main results? Okay, before, if I don't have time to finish, I always like to basically provide a slide with some of these main results. In terms of our conceptual framework, what we're going to show you is that the impact of CECL on loan prices depends, one, on the tightness of regulatory capital constraint, which is basically what banks have been complaining about, right? If the regulatory capital constraint is really tight, it means that they don't have lots of space to basically make additional loans because they might risk intervention from the supervisors because their capital is running too low. That's kind of not surprising. The one thing that basically the model sort of highlights, which is sort of new, is that the impact of CECL is going to be largely dependent on what I call the lifetime loss to 1 year loss experience. Okay, what does it mean by that? So remember, under the incurred loss model, banks were supposed to only provision for losses expected at 1 year ahead, 12 months ahead, right? Under CECL, basically, the banks are supposed to provision or create loan loss reserves for the expected losses over the entire lifetime of a loan, right? If the auto loan has 7-year maturity, I'm supposed to estimate the expected loss over the period of over the entire lifetime and really provision for those 7 years expected losses, okay? So basically, the intensity of the impact of CECL is gonna depend on this ratio of the expected lifetime losses to the 1 year ahead losses, okay? So, and I'm gonna talk a lot more about this in detail, but this is kind of the main idea of the empirical specification, the model that we're talking about, okay? And one interesting point that I would like to emphasize is that prices in the credit markets will be affected by CECL, even if banks didn't basically feel a big pinch in terms of the tightness of the regulatory constraint as a result of the adoption of the standard. Why? Because even if they didn't feel a big pinch, provided that they care just a little bit, what CECL is going to do because of this lifetime approach is change the relative prices, the relative costs for the regulatory capital constraint of a 7-year loan relative to a 3-year loan, all right? And this is going to be key to a lot of what we're doing here. Then we go to the empirical work, sort of we implement our specifications, etc. We basically find economically modest, what we determine to be economically modest effects of CECL on interest rates, okay? Interest rates increase 9.6% for each 1 percentage point increase in capital requirements induced by CECL, okay? We find larger impacts for loans originated by capital constrained banks, consistent with some of the claims by banks, etc. And we find that low credit score individuals borrowing from capital constrained banks are the ones that see their price of credit rise the most, okay? And so there's basically, might be an important sort of, from an equality perspective, this last point might be important, right? The individuals that are most affected by the standard are actually the most disadvantaged ones, okay? All right, related literature. We think that we're contributing to 3 academic literatures. And these, I have a list over here. This list is by no means exhaustive. I really apologize if I'm missing someone that is here on the call. If you feel like I should cite you, please go ahead and send me an email about this. So 3 literatures: timeliness of loan loss provision, credit cycles, and lending practices, okay? And here sort of the seminal works are the works of Beatty and Liao, Bushman and Willis, Jimenez, and et al., okay? So these are basically the papers that really sort of looked at how banks that basically are more timely in setting up loan loss provisions are sort of, how does that affect lending, okay? Then there's a spin-off of this literature, which is basically sort of the CECL IFRS 9 literature, which is already a vast literature, okay? So there's been many other papers that have looked at the effects of IFRS 9 in Europe and in the rest of the world, okay? And basically, this literature sort of came first because IFRS 9 was adopted in 2019. So I already know some things about sort of its adoption. There's a theoretical literature that looks into sort of what might be the expected impacts of these expected loss models relative to incurred loss models. And even though sort of it's not the core of our paper, and we're not actually writing the paper in this way, we actually think we're talking to an important financial intermediation and to a macroprudential literature, right? Why? Because we believe the first paper there is finding effects about what are the impact of capital requirements, macroprudential regulations in capital requirements on lending in the United States, okay? Because we have access to this special individual loan data set that actually allows us to say something about macroprudential regulation, when we actually think this is important because there's many economists out there that need to calibrate their model according to sort of existing parameters, existing estimates. And we actually think that we're one of the first that is able to do it in the United States, and basically to try to estimate what we might expect the additional capital requirements to imply in terms of the price of credit and availability of credit. All right. So hopefully this is clear. I'm now sort of going to move on and start talking a little bit of, yes, Yadav, please.
Hey, João. Yeah, love the setup of the paper. One question that I had, and maybe something that you'll get to later on, so feel free to defer, is it's just the role of these capital constraints. I think even you mentioned in the paper that at the start of CECL, banks were fairly well capitalized, and they're well above whatever the publicly set thresholds were. So how do you think about capital constraints in a world in which, at least on paper, banks were very well capitalized, and the role of those constraints in kind of affecting the pricing and quantity of lending?
That's actually a great question, and basically speaks to something that we were struggling with earlier on in the previous version of this draft. So basically, in the previous version of this draft, what we did is basically do a cut on median capitalization. Okay, and precisely because of what you just said, it turns out that because of all the stress tests, because of all the Basel regulations, going into the pandemic, banks were actually really well capitalized. They were much better capitalized than they were in 2008 when the global financial crisis came. Okay, so basically, in the previous version of the paper, we actually didn't find a strong effect of capitalization on our findings. But why is that? We realize that it's because when we basically separate between below and above median capitalization banks, we were not creating a powerful enough test to basically allow sort of these capital requirements effect or capital tightening effects to breathe. So the way we changed the paper is actually, okay, so let's go and look at just define weak capitalized banks as the bottom decile of the capitalization distribution. And then when we go there, it turns out that the bottom decile, sort of the bank that is ranked at the 10% of capitalization, has a capitalization of 8.83%. Okay, so that's actually still above the sort of the minimum to be capitalized, to be considered adequately capitalized, but it's really right there. If you think about sort of the Basel III Accords, basically have implemented a capital conservation buffer of 2.5% of risk weights, okay? And so that 6% plus 2.5% of this capitalization buffer basically bring us to 8.5%, and which is right there in terms of, and so all these banks are really pressed against this capitalization buffer. And if they breach the capital conservation buffer, they're basically forced to stop dividends and stuff like that. So now we actually think that we're really picking up on banks that are really sort of tightened against capital. So now we're gonna find those results. So I think that was a big sort of improvement in the last version of the paper. It was really sort of honing on these effects to basically try to basically see if they're there. Thanks. Yeah.
May I?
Yes,
yeah.
Please.
Thank you for the presentation. Yeah, it's a great platform. So Great. I have a related question because I thought the capital impact was like it's not immediate, right? So it's phased into multiple years in the future. So like, how does that? So I mean, a general question is basically timing, right? So they have the transition period and then immediately effect after 2020, but the capital impact is not coming until several years later. So I didn't read your paper, so maybe you discussed it. I was just wondering how you think about all this, variation. Thank you.
So we were really lucky. And why? Because basically, at some point, there were proposals for the Fed to do the following: just completely undo the capital effect by keeping two sets of books. If they kept two sets of books under ILM and CECL, they could completely undo the effect of CECL on capital. But they did not. Why? Because banks complained, well, it's too cumbersome to keep two sets of books under ILM, under CECL. So what did the Fed do? The Fed said, okay, we know your initial, we know your initial reserve. And we know sort of what's your reserve right now. So we're going to provide you relief on a percentage of the change in reserve between the start of the day zero of CECL and where you are right now, right? And so this is super important. So the relief happened. But the cost of each specific type of loan to the constraint actually did change. So you see what I mean? So even though there was a relief, now the way it's implemented didn't change the fact that the 7-year loan became much more expensive than the 2-year loan because of this lifetime approach, right? The relative cost of these two types of loans changed substantially. And so this is sort of what we're banking on. So the whole thing is not going to depend at all on sort of whether relief existed. All we need is that the bank cares a little bit about capital. If they care a little bit about capital, then they're going to understand that the 7-year loan just became way more costly than the 2-year loan. And that's going to basically immediately change sort of the way they sort of think about and price these two types of loans. And so this is something that banks discussed a lot in conference calls. So if you basically go to the conference calls of banks around this time, one of the things they'll tell you is that precisely there was a capital surcharge, especially on the long-term loans, and that they would have to basically increase the prices of long-term loans for to compensate them for that. Okay, so yeah. So did this answer your? Ellen. Okay, perfect. Thank you. So I'm gonna continue here. So let me tell you sort of a little bit of our, again, admittedly very simple conceptual framework. We have a 3-period model. Okay, it's a bank sets interest rates of short and long-term homogeneous loans to maximize expected profits in a monopolistic competitive environment. Okay. Banks make loans in period 0 and face a leverage constraint, okay? So basically, expected profits in period 1 are then the returns from the short-term loan, the interest from the short-term loan, and the interest from the long-term loan, minus the losses from the expected losses from the short-term loan and the expected losses from the long-term loan in period 1. Right, the long-term loans that default in period 1. Then banks have to pay depositors a deposit rate, and they have fixed costs. The expected profits in period 2 is basically the interest of the short-term loans that were made in period 2, which is basically came from the reinvesting the funds from period 1 that basically became available from period 1. Then there's the income from the long-term loan. And what's basically the income from the long-term loan is basically the interest times the amount times the long-term assets, the long-term loans that didn't default in period 1. Minus losses expected losses from the short-term loan in period 2 minus expected losses from the long-term loans in period 2 minus the deposit costs, okay? These investments are basically financed by a mix of deposits and total equity, such that investments in short-term loans plus long-term loans must be equal to the deposits and equity of the bank in period 0. Okay, so really simple. So what's the constraint that the bank faces? Okay, the bank sets interest rates subject to a leverage constraint, which is as simple as this, right? It's equity minus the loan loss provision that is defined in period 0, divided by assets, basically deducted from the loan loss provision. They have to be greater than K, which is basically the capital ratio, the minimum capital requirement, okay? So what's the difference between the incur loss model and the CECL model, and how does it affect the constraint? Well, it's actually simple, right? Remember the lifetime approach. According to the incur loss model, banks at time 0 only have to provision for the expected losses in period from the short-term loan, plus the 12 months ahead expected losses associated with the long-term loan, which is just this term over here. It's basically the expected default of the long-term loan in period 1, 12 months ahead. Under the CECL model, we have this additional term. So the same thing, but we now have this additional term. We have not only to provision for the short-term losses of the long-term loan, but also for the losses in period 2 of the long-term loan. Okay? So what does this mean in terms of sort of the maximization problem of the bank? Well, you know, basically what the bank is going to do is the following. So bank is going to have a typical, this is basically typical in all these models, right? So the bank is going to basically put a markup over marginal cost. And the marginal cost here for the bank is basically the probability of the annualized probability of default times plus the cost of deposits. So the cost of deposits. So this is the annualized probability of default and cost of the banks, okay? So the bank is going to put a markup over the marginal cost, and then there's going to be this term, which basically reflects the fact that the bank may be capital constrained. If there's no capital constraints, if the bank is not tight, if the bank has no capital constraints, then lambda is going to be 0, and so the rates are just going to be markup over marginal cost. But if the bank at least perceives that there's some tightness, if the bank perceives that raising capital requirements is costly for them, they're going to have to the interest rate that they charge, an additional term that depends not only on its cost of capital, but also on sort of the contribution of each loan to the cost of capital. Okay, and the contribution of the loan of long-term loan under the incur loss model to the cost of capital is sort of going to be given by this ratio over here. Okay, so how do things change when we move to CECL? So on this side, it is exactly the same thing, right? So markup over marginal cost, but now the contribution of the long-term loan to the capital constraint at time 0 is going to be higher. So basically, this ratio that we see over here is not going to be defined anymore by the expected losses in period 1, but rather by the entire probability of default, both in period 1 and period 2 of the long-term loan. Okay. And for short-term loans, it's the same under the incur loss model and CECL. Why? Remember, because short-term loans are going to be provisioned for regardless of what model we are here, because in both models, they are supposed to basically provision in terms of homogeneous loans for 12 months ahead, right? So basically, the formula is not going to change regardless, okay? So if we assume that we have similar demand elasticities, similar default probabilities, and similar shadow cost of capital under the incur loss model in CECL around the transition from my incur loss model to CECL. And if we assume for simplicity that the cost of deposits is around 0, which actually at the time it was, then we can actually see that the change in rates, okay, the CECL is going to affect the rates that we have, and the change in rates are going to precisely be given by this formula, according to this framework. It's going to be the shadow cost of the bank, meaning how much the bank perceives its capital to be costly, plus a term that depends on the ratio of the short-term probabilities of default to the long-term probabilities of default, okay? So basically, if we're talking about a very short-term loan, you know, all of its defaults are going to happen 12 months ahead in the first period. So this term is going to collapse. It's going to be 0, right? It's going to be 1, sorry. And this term over here is going to collapse. We're going to have basically no effect. If the short-term loans are short-term probability of default is very small relative to the expected default over the entire lifetime, then this term is going to be close to 0. And then there's going to, the transition to the CECL standard is going to have a substantial impact on the relative cost of this loan for banks. And so banks are going to have to charge more for that if they perceive their capital to be costly, okay? So this is what I just said. So basically, these are the key insights of this formula over here. And so CECL, and this actually goes back to Alan's question, right? There's a substitution effect that comes from CECL, from the fact that CECL makes some loans, but not others, more costly in terms of the capital constraint, which means that CECL is actually going to have an effect on the price and quantity allocation, even if there's a transition period, a phase-in, even if the shadow cost didn't change, okay, with the transition to CECL. All right. And so next, so this is basically the setup of how we expect CECL to operate, okay, in terms of affecting rates. And now what I want to do with you is, how do we move from this framework to an empirical specification, okay? So now we're going to think about, what we're going to want to do is estimate a triple difference specification, okay? That basically really exploits the variation between long-term loans and short-term loans. The critical assumption that we always have to make in a triple difference or difference in difference specification and triple difference specification is this parallel trans assumption, right? And so in our setting, this parallel trans assumption means that in the absence of CECL, the differences in probabilities of default between long and short-term loans of CECL banks and other lenders would have evolved similarly, okay? So the typical parallel trans assumption is basically that the difference between probabilities of default of the long and short-term loan of the CECL banks post and minus pre, okay, is going to be equal in the absence of treatment. This is what this 0 notation means, would have evolved in expectation similarly to the evolution of the differences in probabilities of the evolution of the rates of the banks that did not adopt CECL, okay? In terms of our model, if we take our model seriously, we can basically then rephrase the interest rate in basically say that this implies that markups, the probabilities of defaults, and the capital constraints, the lambdas, are also basically have to evolve according to this formula, okay? And so this basically, again, this means that in the absence of CECL, we expect differences in probabilities of default between long and short-term loans of CECL banks to evolve similarly to that of other lenders. We think that the way we are setting up this triple difference specification is buying us a lot of mileage. Why is that? Okay, let me try to explain why. Suppose that the probability of default that the bank faces on a specific product in a specific period can be decomposed in this sort of way. Okay, imagine that there's a common component of the probability of default that is common to a bank in a specific time period across all its products, okay? Think of this as the bank being in a region that was really hit by the COVID-19 pandemic. And as a result, all the customers in this region are going to be sort of in real trouble. And the probability of default of all the loans of the bank are going to increase a lot. regardless of the type of loans and maturities of each loan, okay? Then think of that this can be decomposed in this term, plus a term that basically captures the trends in the probability of default of specific loans and maturities, plus an idiosyncratic term that is specific to a specific bank, a specific maturity in a specific period, okay? So this is sort of the idiosyncratic term of the probability of default of a bank, okay? So what I want to convey here is that if we did a simple definitive specification, we were not going to be able to get rid, we talk a little bit about this in the paper, but here I'm just going to talk it through, okay? We were not going to get rid of this term over here, okay? So, and this is probably very difficult for the empirical strategy. Why? Because, I mean, you might see how CECL banks might be different than other lenders in terms of their exposure to factors that might affect their overall probability of default. By doing this triple difference specification, meaning taking differences between long and short-term loans within a bank, then the parallel trends assumption can be reformulated this way, okay? And so basically what it's telling us again is that the common components of the CECL banks can trend differently from those of other lenders, as long as the difference between the idiosyncratic probabilities of default of long and short-term loans evolves similarly across CECL banks and other lenders, okay? So what we can't have then is that there's a specific shock that affects some maturities, the long-term maturities more than others, and that asymmetrically also affects CECL banks more than others, and happens to coincide with the adoption of CECL. That we can't have, okay? But we think this is much more palatable than basically just saying, well, we can't have that CECL banks evolve differently from other lenders, okay? So which is basically what the triple definitive would imply, okay? So if we believe this identification assumption that we laid out, in the context of our model, our conceptual framework, our triple difference specification, we'll estimate this. We'll estimate an average treatment on the treated effect, which will be given, according again to our conceptual framework, will be given by this, okay? So basically it's the formula is similar to the formula that I showed you earlier, but what we're trying to convey is that under the parallel trends assumption, we can estimate this, okay? And again, so this is going to be the cost of capital, the shadow cost of capital, and this term over here, which basically is going to capture the intensity of the impact of CECL across different types of loans. Again, this lambda is a key parameter in the whole thing, right? The lambda is basically telling us that speaks back to the entire debate. What banks are saying in sort of layman language is that their lambda is really high. They're basically saying, well, capital requirements are gonna matter a lot. We care a lot about capital requirements because capital makes us operate in a much more costly way, right? That's basically what they're saying. And so we don't want CECL because of this. And so what we're going to do in practice is actually speaking to this debate by estimating this equation, okay? And basically see if the banks are acting the way they basically talk about. If they are changing rates of all the loans that they basically offer in a way that is consistent with their claims. So we're going to estimate this lambda post, and we're going to try to figure out if it's high or low based on sort of observational data, and that's going to allow us to basically really test what the banks are saying. Yes, Yadav, please.
Yeah, João. So I was, very intrigued by this lambda in your setup, and just thinking, what is the role of like forbearance in this setup? I guess can I claim that you're assuming like kind of perfect and benevolent enforcement in this setup where the supervisor are going to act kind of in some non-conflicted way, where in reality, you and I, we all kind of know that if they project that lambda might increase, by X%, it's like X minus some fraction percent that might actually increase because the supervisors might be lenient on them for some reason or another. So just, I know that the model has to be kind of tractable in some way, but just wondering if you guys thought about that at all. Yeah.
No, so I think that question sort of has two answers, right? Mm-hmm. So one thing is that these models were basically audited, right, by auditors, and so one thing that we could quibble with is, well, they say they adopted CECL, but are they actually doing the right thing? And therefore, are you basically able to measure any of this? Because sort of maybe there's forbearance across the system. Maybe regulators didn't really expect to see whether they were doing this, or gave them some sort of leeway in the way they were actually implemented to sort of not such that they didn't have to increase loan loss reserves that much. The auditors might have also looked the other way. That I don't think it's happening. And the main reason is you actually see the loan loss reserve jump a lot. Right, so I think it did something around 2020. Yeah. Actually jumped a lot, and actually in some way you might actually claim that it overshot the loan loss provisions, because what happened is that in Q1 2020 loan loss provisions increased substantially, and then they actually went down. They went down a little bit as sort of the COVID pandemic was not as dire as many of the banks suspected it might have been. The second thing that I want to basically say is that I think in some way your question relates to Alan's previous question, right? Mm-hmm. There was actually forbearance, there was forbearance. So there's at the time of that COVID basically was adopted, COVID sort of happened. Banks were regulators was really concerned, right? I mean, and banks were like, well, and now not only this is a threat to our businesses, do we have this new accounting standard that is also going to additionally force us to basically do these things. So what the regulators did was actually allow, basically at that time, I think this is actually in the CARES Act. The CARES Act was basically allowed for a transition period, for a phasing period of the effects of CECL on the capital of banks. But again, this basically goes back to my previous retort to Alan's question, which is, well, the forbearance itself doesn't affect our estimates too much, provided that banks really still understood that a long-term loan became more costly than a short-term loan. Than a short-term loan from a capital constraint standpoint. So I don't need. Yeah. So it's basically this idea of wealth effect from Econ 111 versus substitution effect. Sort of what the regulators did was sort of compensate the banks for the effect of CECL would have on their overall levels of capital. But what they didn't do was undo the change in the relative prices of each loan to the capital constraint. So again, all I need is for some banks to care about capital just a little bit, even despite all the forbearance. I need some banks to care about capital a little bit, to think that it's costly, for the results to operate in terms of so all of the sudden, some loans became relatively more expensive than others. I hope this basically sort of answers your question.
Yeah, it does. I think the one thing that I thought might help the paper is that you characterize your effects as economically modest, and if anything, this in the background might make the estimate stronger, right? Like if you were able to, perfectly observe what's going on in the background, then I think that it's not as modest as you might think, because there are all of these other kind of forces in the background relative to their actual cost. Yeah.
You're the guy. You're the person to talk to about these things. So maybe we can devise something interesting to talk about further in the future.
Sure.
All right. So basically, so finally, one thing that I want to say is that actually we can do even better than estimating this, because we have TransUnion data, and the TransUnion data as performance data for each type of loan. So one thing that we do in the paper, and that's going to be key for everything we do, is that we can actually trace back and recover this parameter over here from historical performance of loans. And that really is going to allow us to recover the lambda post. Okay, so that's basically what we're going to be doing next. Okay, so this is our triple difference specification. So in the conceptual framework, I only have two maturities, but in practice, you know, like our data has multiple maturities of 12 months, 24 months, 36, 48, and up until 10 years, if I recall. Okay, so we need to basically use all that data in a tractable framework. And so this is basically what we came up with. Okay, so this is the log of the interest rate. And then we have our main treatment variable, which is a post times CECL times the intensity of CECL term, which is basically what I just showed you over here. Okay, so this is going to be key. And then there's going to be a battery of fixed effects. Okay, let me go over with you through this battery of fixed effects, at least the way I think about it. Okay, this guy over here is the key guy. Okay, this is the key fixed effect in our specification. This is the bank time fixed product fixed effect. Okay, so this is what allows us to basically really look within the loans that a bank makes in a specific period. Okay, we're always comparing longer term loans versus shorter term loans within a specific period. So again, the COVID pandemic shock doesn't really affect our estimates too much because we're always looking within at loans that were more affected by CECL relative to loans that were less affected by CECL. Okay, and the fixed effect that really operates this is this one over here. Okay, then we have a battery of other fixed effects. Why do we have them? Well, because we can, and because we think they are helpful. How are they helpful? Because they are going to absorb other systematic differences in how CECL banks and other lenders might be exposed to factors that affect some maturities and product types more than others. Okay, so for instance, credit scores. Okay, let's suppose that the lower credit scores were more affected by the pandemic. Okay, but just suppose, I don't know if it's true or not, and that for some reason CECL banks were more exposed to lower credit scores than other banks. Okay, so even though it's not key, we want to absorb that variation to make sure that we're not confounding that this beta really captures just the effect of CECL. Okay, so basically that's one example of what we're trying to capture here with these other fixed effects. And so it's that's sort of the underlying reasoning why we have this thing. And the paper sort of explain each one of them and what they're doing. But here I just wanted to sort of gloss over them and tell them sort of that's the philosophy that's guiding us basically to include all of this stuff. And then there's this term, right? This term that I told you about, right? The intensity of CECL, the ratio between expected losses 1 year ahead versus expected lifetime losses. Okay, so here's what we're doing, right? So we know, because we have the TransUnion data, we know sort of how loans default over time for each type of loan. Okay, so we looked at historical performance, and for instance, we know that the delinquency rate of auto loans with a 36-month period looks like this. Okay, so they basically default a lot, actually. And this is something interesting that, you know, I didn't know. Loans tend to default a lot in the first year, right? So this is the blue area over here. And so this is basically the area that banks were supposed to provision for under the incurred loss model. Now, under the CECL, not only do they have to basically cover and reserve for the blue area, but they also have to reserve for the expected lifetime losses, which also now cover the orange area. For a 60-month loan, banks also had to, under the incurred loss model, they had to basically, previously they had to cover this blue area, and now again they have to cover the blue and orange area. So this is, again, graphically the sense in which CECL was more intense and more impactful for a 60-month loan, for a longer maturity loan, and a short maturity loan. They both types of loans had to increase in terms of the loan loss reserves that basically were set for them. But as you can see over here, the ratio of the orange area in the 60-month loan to the blue area is greater than the ratio of the orange area to the blue area in the 36-month loan. So you can say that the 60-month loan became relatively more expensive than a 36-month loan for banks after the transition to the CECL model. So this is the key thing that allows us to do all of this, okay? And so this, as you might imagine, the share of defaults occurring after year one is going to increase with loans maturity, and which is what we show here. The longer the maturity, the greater the share of defaults increasing after year one, which is something that you might expect, right? I mean, the longer the loan is, the more likely it is that the individual just gets a shock to its income, to its wealth, that forces him to default, right? So that's the sense in which the likelihood that we have a higher, this ratio is going to increase with maturity is pretty high, okay? So this is basically the graph that shows this idea, okay? So this is basically the variation that we're going to use to estimate this, and that's going to allow us to estimate, okay? So now let me show you empirical results. All right, so first of all, a few descriptives. I mean, here all I want to say is that, like interest rates of auto loans typically around 7%, interest rates 17%, of personal and secured loans, which you might expect, right? Because it's a non-collateralized loan. These are sort of the terms that we're going to be using in the analysis, okay? This is basically to show you the evolution of rates, overall rates, across all maturities and quantities for CECL banks and other lenders, okay? The reason why I want to show you this is to show you that these things actually do not move. The parallel trends assumption in a typical diff in diff would probably not be, it would be sort of a heroic assumption, okay? Why? Because you can see, for instance, that around the pandemic, for instance, over here, CECL banks seem to have been substantially more affected than other lenders, okay? So we really need to basically find a way, as we try to do, to basically try to control for these forces that might affect CECL banks and other lenders differentially. We hope that we're able to do this. Yes, Helen, please.
I really like your pictures. But on this one, I have a question. It's kind of a shocking in a way to see, different lenders charge different prices for consumer loans because, at least within a region, consumers shop around, right? So you were like, hey, if one bank raises their price, consumer will go to another lender. So I'm just curious, have you on the one hand, you can say this will work against finding anything because of the spillover effect, right? But on the other hand, I'm also curious whether, at least maybe within a region, do you observe that kind of a spillover effect? Do you see the price, for concentrated market, somehow they go up more than in the competitive market? Does that mean the borrower doesn't really shop around as we thought they are?
We haven't, so let me tell you two answers to this. We didn't do anything around search, right? Search is related to our model in the sense that we are assuming a monopolistic competitive environment, right? We're saying what this means that we're saying in our model, we think that our banks have some local market power, right? One way to interpret what you said is, well, this market power is really small. Why? Because customers actually shop around a lot. So they actually shouldn't have this little market power, as much market power as you think you have. You're saying their monopolistic competitive environment assumption might not be granted. I'll give you I think this is something that we haven't explored. Might be really interesting to try to basically go down this path and sort of future versions of the paper try to do this. But the one thing I want to say is that, I mean, there's papers out there in finance. Chris Palmer has a paper on the auto loan market, and Gregor Matvos and Amit Seru have a paper in the mortgage market called Searching for Approvals. And my sense of those papers is that consumers, believe it or not, I find this very strange, but believe it or not, most consumers are very unsophisticated and they don't search nearly as much as we think they should. Okay, so in some sense, that basically sort of supports a little bit our assumption that these banks do have some local market power that they may be able to exploit. Now, thanks for your point, and this is something that probably I'm going to try to explore, because it is true that the degrees of market power might change across environments. So that's something that might be very interesting to
I believe
further.
your story, because these are factual information, right? So apparently this is not a one price in one market situation. So I'm just curious if you can maybe exploit a bit more on the market structure.
Yeah, no, exactly. That would be really interesting. I can tell you for sure. There's tremendous variation. There's tremendous variation in prices, and partly because they must have something. Jacob, please.
First of all, thank you a lot. I think this is super interesting. One, I'm sort of on the same, like a follow-up on this one, where we see the price differentiation, because here in EU, one of the common discussion points have been that banks who were, IFRS 9 was here, banks who were subjected to it became more prudent in lending. So basically it meant that, loans that you would give out before, you said, no, now I get the cost on my P&L right away. I'm going to be more prudent. So you basically withdrew some of the most sort of risky segments. You said, no, I see the cost right away. I don't want that cost in my P&L right away. So the banks, what you saw was a shifting in the lending. Basically, the most risky segments no longer got as many loans. And that then, of course, also, since there is a strong correlation between what price you charge and what risk there is, that also created a dependency there. I'm not necessarily saying that this what's going on here, but I just thought that's something that we have discussed quite a lot.
Yeah, I'm going to show you something that speaks a little bit to that. That's the final sort of table figure in the paper I'm going to show you, and that actually, it's not only sort of there's this sort of changes in the risk composition, and there's also a question of where these risks are basically. I think this is actually very interesting. Something that we didn't delve into is where are these risks gonna then go? Because what might be happening is that they actually go outside the banking system. They go to the shadow banking system. And then in terms of the data set that we're looking at, there's even a question about distribution, which is sort of the way we're also sort of angling this, which is, if we penalize the riskier portions of the market, and if this, especially in the consumer lending, the riskier portion of the market are actually the least wealthy individuals, then they're they actually are the ones that need insurance the most, and they are the ones that need a bank to be there for them when they basically receive a negative wealth shock. Then we have to start thinking carefully about these welfare implications of these things. So, and I'm gonna sort of show you. That's gonna be my last analysis.
Thank you.
Thanks for your comment. Yeah, okay, so this is basically the purpose of these graphs is to show you, well, there's substantial variation, and not only that, is that they seem to basically evolve in different ways. That's why we need sort of something, a specification which is very tight to be able to tease out the impact of these external forces like the pandemic, and to tease out the seesaw effect from them. All right, so this is basically my first table. Okay, so we do a few things here. So this is the main result. Okay, so one standard deviation increase in the intensity of seesaw, which is basically this parameter over here, is associated with an increase in interest rates by 2.5%. This is 2.5%, not percentage points. Okay, so what this means is that if a loan was 10%, after CECL, the loan would become a 10.25% interest rate loan. Okay, if for one standard deviation increase, we are worried about sort of, again, even with these all paraphernalia of triple different specification and fixed effect, we're still worried about the pandemic. So one thing we do is actually exclude the coronavirus period, sort of the height of the pandemic, to see whether the results hold when we basically take out this specific period, they do. Then we estimate separately for auto and unsecured, and we find that even though like both results are statistically significant, are economically positive, only the the results on the auto loan markets are statistically significant. Okay, at least in the full sample. Now, how do we interpret these results in a way that sort of a layman, a policymaker will understand? Okay, so because this result again is sort of the semi-elasticity of a one standard deviation increase in the intensity of CECL on interest rates. What does that even mean? Okay, so we did some back in the envelope to try to sort of figure this out. Okay, so here's what we think these results mean. A one standard deviation increase in this parameter implies a 26-cent increase in loan loss reserves. So basically, the way we did this was basically go to the current loan loss reserves of CECL banks, and then we try to figure out what's the impact of 10% increase on in this orange area relative to the blue area, right, that I was telling you about. And so what does that mean in terms of loan loss reserves? And we came to this sort of figure of 26 cents increase per each $100 of consumer loans made, okay? So every time a bank makes $100 of consumer loans, because of CECL, it would have to basically set aside 26 cents more if their intensity, the impact of CECL increased by one standard deviation, okay? What this means then is that per $1 additional in loan loss reserves that the bank has to make for every $100 of loans that it makes, we find that the loan rates increase by 9.6%, okay? So meaning if CECL induces banks to put $1 additional of equity aside for every $100 of loans that it makes, we find that this basically is going to generate an impact of 9.6% on the interest rates that it's charging, okay? So how does this compare with other papers? There's a paper by Matteo Benetton in European setting, UK setting, that basically finds a really comparable estimate in the mortgage market. It doesn't use the impact of CECL, but it uses changes in risk weights that are charged on each type of mortgage loan. And he finds that a $1 increase in the equity that the one bank must set aside for $100 actually impacts mortgage rates by around 9% as well. So it's very comparable. We're actually very happy. It's actually, this estimate is actually quite smaller than some of the estimates that we have found in some of the current IFRS 9 literature. For instance, Aitekin, Ayrton, has a fantastic paper, but his magnitudes are actually much larger. I think he's basically around 20 to 30%, okay? So I think sort of that's why we're saying we think that these estimates are basically not too large. They seem a little bit modest and not sort of, I mean, especially if you hear the banks speak, it sounds like the world's going to fall apart and they're going to have to charge prohibitively large interest rates. And we think that sort of charging 10% more for 9% more for a $1 increase in capital reserves doesn't seem that large. All right. So next, now I want to focus again, sort of the idea here. The banks say that there's a capital constraint channel, right? And now I want to focus on this channel over here. So I'm gonna focus on the bottom decile of CECL banks to try to see if the effects are stronger for these banks that are more likely to have substantial constraints and they feel the tightness of their constraint. And we do find that, okay? So basically the magnitude of the coefficients almost double when we basically focus on the subset of CECL banks that are not very well capitalized. And now we actually find results both on the auto market and on the personal unsecured loan market, okay? So it is true that the results seem to operate through a capital channel, at least to some extent, right? These are the plots. the plots, basically, there's two things that I want you to take away from this. One is that, there's no pretense. This is another way to basically to assuage our conscience that, there's nothing weird and funky going on, right? The fact that the pretrends are very stable, basically gives us some confidence that there's, that our estimates are doing, our estimator is doing a good job. And then we have this sharp increase right around the adoption of CECL, okay? So as you can see, basically around the first quarter 2020, the rates go up and basically persistently stay up around 2.5 to 4% since the adoption of CECL. This is interesting. On the other side, we basically have the dynamic graph when we focus on low tier 1 banks. Here, what we see is that, again, so there's no significant pre-trends, and then we have a spike in Q2 of 2020. So the way we kind of interpret this is, well, these low tier 1 banks were the ones that were really frightened by the effects of the pandemic, right? So at that point, given that there was significant uncertainty in the economy about what the future was gonna hold, they basically said, okay, so we need to be really careful with our capital. So we need, in Q2, they really raised the cost of credit of the long-term loans relative to the short-term loans. And then as things sort of eased over the following quarters, we see that sort of they actually come down, but still stay persistent in the around 5%. Yes, Yadav, please.
Hey, João. So I was just wondering if there's any kind of mileage in that lender cross maturity, cross product fixed effect, because there is also this literature on culture, and I think like Fallenbrock and Stoltz have this paper on how banks are kind of persistent in their behavior over time, and their performance in the 98 crisis kind of predicted their performance in the 08-09 crisis to a certain degree. And I'm just thinking about the types of financial institutions that really engage in consumer loans is very different maybe than the median bank. And this is much like what Helen's suggestion is, you can kind of use this incredible data at your disposal to see if there's any interesting variation you can exploit, like auto lenders who have this specialization in a specific type of lending might behave very differently than diversified lenders, and so on and so forth. It's just a suggestion. I'm trying to kind of think more about the variation that you can use.
We're really just tapping the sort of the surface of these.
Yeah.
This basically took us a couple of years to basically start operating on this, because it's really a humongous thing. So I think we're again. That's very interesting. Basically, you're saying how much mileage. So first of all, what's the incremental R square of this lender by maturity, by type of product fixed effect? Mm-hmm. I mean, how much do we explain of the cross section of interest rates by just looking how some lenders behave over time, right? If it's a lot, really speaks to what you're saying, right? There's some habitat, some specialization, and these specializations matter a lot for what they're doing.
Right.
And the second thing is that, we didn't think about that, but that's actually pretty interesting. Something to think about in future projects. Yeah. Thank you. Yeah. All right. So this is new. Okay. I'm placebo test. Okay. Again, I've already I've already bored you with the intricacies of the triple difference specification, and we went through that with excruciating detail, but we still think that, okay, what if there's something about the COVID-19 crisis that really drives and really affects our main identification strategy? Okay, so that in ways that we don't understand, what can we do? So what we thought about, let's try a placebo test. Okay. And the idea is the following. We can go back to the global financial crisis. And this was a crisis which, didn't have exactly the same characteristics, but had some features that were actually pretty similar to the pandemic crisis, right? What we had in the global financial crisis immediately was a substantial loosening of both fiscal and monetary policy. Rates went to zero almost immediately across all maturities, just as happened in the recent COVID crisis. And there was substantial fiscal intervention, right? Cash for clunkers, other fiscal policy interventions in the US. So, but there definitely wasn't any change in accounting in the accounting standards. So this is really cool, this is a really cool placebo test that we can run. Try to see if we have a situation in which we also have a crisis, if we basically have a similar behavior of our empirical specification in that setting. Unfortunately, we don't, right? Here's basically, we have data, fortunately, starting in 2008 until 2011 Q4. And as you can see over here, it passes this our empirical specification passes this test of the global financial crisis. So basically, coefficients are mostly stable and persistent, both in the sample of all lenders and also in the sample of lowly capitalized lenders. Okay, so basically, mostly persistent and constant over time. So definitely we don't see anything like here where we have an increase that basically stays there. Okay. All right. So taking stock. Okay. So showed you a conceptual framework of how to estimate this thing. Just showed you, I think, that the CECL significantly increases interest rates, albeit with some modest economic magnitude. But you might ask, well, what about quantities? Because it's possible, maybe you're underestimating the effect of CECL, because it's possible that it's not operating through prices, but rather through quantities in the consumer lending market. And we know that this is plausible because in markets with lots of adverse selection, you might expect the optimal response to be by restricting the size of loans, by demanding a larger down payments, as Stiglitz and Weitz and Baster 85 basically has suggested for a long time. So what we're going to be doing next is basically try to see whether maybe the impact of CECL is manifested through reductions in quantities. Okay, this is a result for the entire sample. Okay, we actually don't find statistically significant effects of CECL on the entire sample, but when we hone in on the quantities offered by the sample of banks with weak capitalization, we do find a little bit of effect. So the price, so I think this tells us is that one possibility for why this might be happening is that these were precisely the banks that raised prices the most, and they might have felt the need. So as they raised prices, it's possible that they considered, well, let's take it easy, because if we raise prices too much, we might run into an adverse selection problem in which basically we're just drawing the bad types and making loans to bad types. And so let's also use a little bit of the quantity channel to constrain lending a little bit. And so we do find reductions in loan size after CECL for CECL banks that are weakly capitalized. And here the results, there's no significant pre-trends, but the results are less sharp than they were with prices. So I would say that most of the action seems to be in prices. And if anything, maybe what might have happened is that once basically CECL banks that are lowly capitalized, at some point, they really started realizing that they should be adjusting through quantity rather than prices. Okay. All right. Interest rates go up, quantities go down only for weakly capitalized CECL banks. And then now this final part basically goes back to Jacob's previous question, okay? Is it possible that CECL in some way is inducing some redistribution of loans from riskier borrowers to riskier borrowers to less risky borrowers, or put some differently, to borrowers with really low credit scores to borrowers with high credit scores, okay? And then think about a little bit the welfare implications of that. And so what we have here for that is the following, okay? So basically, we have a very similar specification, but now over the triple difference specification, we're overlaying an additional indicator variable that tells us what is the credit score of the individual. So in that sense, what this is doing is estimating treatment effects of CECL in the triple difference specification differently for each credit score beam, okay? And so what we find is the following, okay? So interestingly, for the entire sample, and here the entire sample, the effects of the entire sample here by credit score are in red. For the entire sample, we actually don't see a significant effect of CECL across credit scores. And if anything, it went against what we were actually predicting, which is that the lowest credit scores don't seem to basically see their interest rates increase by as much as the higher credit scores. But when we again focus on low tier 1 banks, the ones that are really capital constrained, we see that the riskier borrowers that are banking with them actually see much larger increases, point estimates increases in their interest rates relative to all other types of borrowers, okay? And so this is basically, so what this tells us, in my mind, is that the greatest losers in terms of the spectrum of clients with the adoption of CECL seem to be very risky borrowers that are tied to banks that are weakly capitalized, okay? Going back to Alan's question previously, why didn't they search more? Maybe because at this at this level of credit score, they might not be sophisticated enough to search. They might, have to go to these banks because they're the ones that they have a relationship with. Nobody else would lend them. But when they do, they actually do receive much higher interest rates because of CECL, okay? And on lower sizes, again, here, this result is a little bit noisy, but we do find in terms of loan sizes, we do find an effect that is more pronounced for, or at least increases with the credit score being both for the entire sample, and also for the low tier 1 sample, okay? And that's all that I have for you, okay? So basically concluding remarks, basically we have a paper. The paper basically has a model framework that allows us to think a little bit about the empirical implications, the empirical specification. Again, it lays out an economic mechanism through which we think the CECL will work. And that will be, one, the tightness of the regulatory capital constraint, and two, the lifetime loss to 1 year loss experience. The empirical work suggests modest economic effects of CECL on interest rates, no statistically significant effects on loan quantities, except for weakly capitalized banks. Low credit score individuals are the losers in this whole thing, the greatest losers in this, especially if they're banking with weakly capitalized banks, okay? So I think in general, going back to the centering back on the main policy debate, we do think that our results support a little bit the evidence that banks did act in a way consistent with CECL having an effect on the cost of consumer credit, but probably doesn't justify the histrionics and the congressional hearings and all the complaints that they had, and especially the way they complain, okay? So we do think that our results are more contained than what the banks seem to suggest they were. Yes, Jacob, please.
Super interesting results. I would say I love the presentation. There was, I think, a few months ago, there was a paper from ECB on this topic where they discussed like how much do different banks provision then under IFRS 9. And interestingly, their conclusion there was that there seemed to be sign of let us call it earning management, so that banks not necessarily provision the right amount, but they provision as much as they can within their capital headspace. So they had, if I remember the study correctly, they had corrected for credit quality and shown that how much sort of capital headspace you have is a strong determinant on how much you provision. Basically, there is an internal pressure, like, guys, don't write down too much because, you know, we don't have the room. And I was thinking, have you guys thought about any of these effects that, you know, because it is a very complex standard, and there is a lot of room for adjusting it in different ways, and then there might be internal management pressure on this. In particular, when we look at weaker institutions that often are smaller, often have considerably less resources, often weaker governance as well on this.
Yeah. So two things about this. So there's two papers that I think I recall. There's the Yanis Bischoff paper that looks at the adoption of IFRS 9. I don't know if this is the one you're thinking about.
Yeah, that might be it.
That's it? That's the one?
I think
and there's
so.
another one, I think by Marcus Ban. Not entirely sure. So the one thing they are actually, the Yanis Bischoff paper, which is the one that I know better, is actually using something which is a significant difference in how IFRS 9 was adopted relative to CECL, which is actually at the heart of what I do here. Basically, CECL decided to go with a lifetime approach. And again, there's plenty of legal wiggle room in the lifetime approach, especially because it's, you know, estimating lifetime losses is probably very hard, especially for loans that are 20 years ahead. There's probably considerable parameter uncertainty in this estimate. So I'm not basically, I think you're totally right. Sort of one of the issues with CECL and the expected losses model is that it's affording a lot more discretion. The Bischoff paper is actually doing something. So IFRS 9 decided to go with a non-lifetime approach. They continued on a sort of a 12-month approach, and banks were only supposed to then transition to lifetime if the rating of the loan falls below a certain threshold. And so what Yanis and others are doing, which I think is super cool, and you're totally right, is that basically what they're saying is, well, they're actually manipulating the ratings a little bit, and especially if they're capital constrained, to avoid that the bank transitions from 12 months to 1 year. And so this additional degree, what they're saying is this additional degree of discretion is allowing banks to do a lot to obfuscate and sort of, not only obfuscate, but also get some forbearance and sort of then try to basically limit.
I fully agree. And in particular also, like, where, when are you supposed to transition it? So not only that, you have a certain rating and that rating has moved, but what rating change are you supposed to move in? There is little to sort of no guidance on this. So, I mean, I work in the banking sector. I've been on 3 banks. All 3 use completely different systems on this. So there's a huge disparity in practice.
That's super. I didn't know that. I'm actually, this is really cool information. I had no idea. I would love to basically do more in that respect. So in that sense, so Yanis's paper in some way actually, I think it supports a little bit the lifetime approach that CECL took. At least they took away this degree of discretion for them. Certainly, there are still many degrees of discretion that banks are still using, but I think that basically at least they took away this lever, which I think, yeah.
But thank you so much. It's super interesting.
Yeah. I appreciate it. Thank you. Thanks for coming. Shahid?
Great presentation. Thank you for all the slides and all the great comments that came. One thing that was coming based on this last question is there any way you can do a cross-sectional based on how conservative some banks are versus less conservative? And especially if there's a lot of ifs and if discretionary about the long-term expectations?
These are things that we would love to do. Unfortunately, let me tell you what the problem is. We were able to grab hold of this data under a strict confidentiality agreement, and in a way that we cannot sort of identify. So we have the data, and what we know is we don't know which bank is which. We know its capitalization, and we know if the bank adopted CECL or not. Why? So because this is really sensitive. This is really sensitive data, and TransUnion, the data vendor, was now willing to basically allow us to determine who the lender is. So what we have is basically these two flags. So for what's their capitalization and whether they adopt the CECL or not, and then we run our analysis. So we would love, I mean, love to basically bring more bank characteristics into the fold and really sort of analyze all these interactions that you basically discussing. For sure, for instance, one of the PhD students that we have on the market, Cristiana Vidinova, and I'm going to do a little bit of advertising of her paper. She has a fantastic paper on the impacts of CECL, and what she finds is that, depending on, banks are going to be more or less optimistic in terms of how they basically set up their provisions, and that's going to basically impact a lot how sort of the impact is going to influence a lot the procyclicality of lending after the adoption of CECL. Okay, so this is one of the things that if we could basically layer in our and basically bring into the fold in our setting, we would be super excited to basically test this Earth theory and basically bring it to the data. Unfortunately, so again, sort of because of this confidentiality issues, we cannot just bring the kitchen sink and basically throw it at the data. They won't let us do that. So we are sort of limited in what we can do. We think sort of the most important thing that we thought about it, the mechanism that we wanted to basically tease out was this of the capital channel, because banks kept referring to it in the conference calls. But that's all we are actually able. That's all what we're actually able to do. Maybe in future versions, maybe in the future paper, they might be able to do something else. But this one is constrained to this idea. But thanks for your comment. This is really, I think that this would be amazing if we could do that.
Thank you. Thank you.
Thank you very much, dear Professor João, for your contribution and your effort. It's really an excellent presentation and excellent paper. Thank you very much. If anyone have any questions, you can open your mic and ask your question.
If I could just add one more thing. I think this is an excellent paper, because one of the things, or the presentation, because so it is a little more of a comment, but one of the things that we talk a lot about is that I think, again, this is from an IFRS 9 context, but that the standard is sometimes a little bit misunderstood. Like, what a lot of banks focus a lot on is the P&L effect. But if you look at a portfolio in equilibrium, just as an example, you don't really have a P&L effect, because where you provision doesn't really. I mean, if you provision really, really late, right, when you write it off, or you do it really early, that doesn't really affect the P&L once you're in equilibrium. What it do affect is your balance sheet. They do affect how much you write down. So I think really what I really love here is that it really highlights that the key thing is the balance between how quickly you get the sort of workout cycle of the thing. Like if the defaults arrive very early or they are very late, that's the really chief effect that you should be that the sort of standard depends on. So I think it's really beautiful to see that then as sort of the controlling effect that's being used. It was incredibly beautiful.
I appreciate that. And this is actually something, if we want to basically make the model as parsimonious as possible. We don't want to basically, it's already too much paraphernalia for a paper which is in its core. It's an empirical paper, but as you said, I think you're exactly right. So what's going to happen if we basically expand the dynamics of the model? What would happen is that what CECL is doing is sort of front-loading the loan loss reserve and really having an effect on the balance sheet. And then its steady state, it would sort of remain at a sort of similar level as the portfolio is balanced. And then what would happen is that in the very last period of the bank, the loan loss reserve would basically be wind down, right? Let's say that the bank basically closes, and the loan loss reserve in the last period of the bank would have been lower than sort of what under under CECL than what it would have been under ILM. But basically exactly that sort of the balance sheet effect is going to be there in equilibrium, but not in the P&L. I think that's exactly the way we're thinking about it. Yeah. Thank you so much.
Are there another question? If anyone have any questions, you can open your mic and ask your question.
Yeah, sure.
My last comment would be like, I think that the model really helps show where the identification is. And then just with the number of observations, it's great that you have a lot of observations here, because the law of large numbers will help you with, getting the right statistical estimate here. And I think the identification is really good, and that the empirical model kind of ex ante helps predict what will be found. Then I think there is like a lot of emphasis on, the reasoning as to why you include these fixed effects. And then I like how in the presentation you kind of explained what's key and then why you use this bucket of fixed effects as well. Then also saw that there was a lot of emphasis on the parallel trends assumption that you showed. And also the placebo test is a nice addition that I didn't see in the previous version of the paper. Yeah. Then I was wondering whether like it would help in any way just to provide a constructive comment. You can take it with a grain of salt. Whether it would be possible to potentially have not just like the low tier 1 banks, but then other than the low tier 1 banks, and then create a sample like that, and then run the analysis with that subsample, and then do a parallel trends assumption there, and then see if there's a significant difference between that group and the low tier 1 group. And that was just one comment. And then another one was, is it possible to, this is just really kind of like a conjecture, is it possible to conduct like a synthetic difference in differences in a way, like create like a synthetic control group?
Well, so on the first one, I think that might be interesting. We thought at the bottom decile sort of with, what we thought is that the non-bottom decile would be very similar to the entire. So because bottom decile is also just a sliver, so we didn't think it was sort of key to basically show sort of the effects for the non-bottom decile, because it was going to be. But I agree with you that for completeness, probably we need to show that in the independent synthetic control. Like synthetic controls, I feel like synthetic controls are more adequate to a situation in which you have not very many observations and the intervention affects it's almost like a case study that affects one group or two groups. Typically, synthetic controls are sort of, I don't know, like that. Maybe you can talk a little bit more offline, but I mean, at least the literature that I know in synthetic controls, the initial literature is mostly like on what happens with the reunification of Germany is like relative to a control group in terms of economic growth, right? What happens when California adopted an anti-tobacco policy relative to a pool group of other U.S. states. So I think, I at least tend to think of synthetic controls as something a little bit more that fits better a situation where there's an intervention that affects a group, one particular group or two, rather than this situation where we have, millions and millions of loans. Yeah.
Thank you.
Yeah, welcome.
Thank you very much, dear Professor Gua, for your contribution and your effort. It's really an excellent presentation. Thank you, everyone, join us today. Thank you very much.
I appreciate all your comments a lot, and thanks for opportunity and to show my work. Thank you.
And I hope to see you soon in Egypt. You are very, very welcome, dear Professor.
I appreciate that. Hopefully I'll be able to come. And not so distant. Thank you.
Thank you very much.